And we are live. Good morning. Good morning. Hopefully we're live. I gotta double check to make sure everything's working. All right. I'm using the audio from my AirPods. Okay. So, what's up? What's up? Good morning. So, if the audio is fine on your end, can you let me know in the live chat real quick? Let me know if it's fine or if it sounds like terrible, and I can change it. It's good? All right, cool. Because I can toggle it to this one. Watch. See if this is a difference. Watch, okay? All right, so now I just changed the voice settings to a different one. So I wonder if I sound different right now, and then I'll change it back. And now I just changed it back. So as long as everyone says the audio is good. Unfortunately, for whatever reason, Restream doesn't have an app that's louder. Is that good or bad? Sounded, oh, it's a lot louder? Okay, so we'll leave it the way it is. I put it back on the AirPods, right? So it should be fine. Greatest coffee mug ever. Oh, the window. You can't see it from the glare. Got candlesticks on it. It says millionaire in progress. Greatest coffee mug ever. One of the kids' toys is so loud. Jesus. Oh, yeah, what I was saying, Restream doesn't have an app that I can download. I have to use it on the browser. And when you use like your internet browser, like I'm using Safari right here on the MacBook, it doesn't allow noise suppression for background, which is strange. So hopefully just the normal settings on the AirPods is enough to where it doesn't hopefully have too much background. Let me get the if everyone could like and yeah, I changed it back. It should be fine. We should be back on the normal settings for the noise. Should be good. If everyone could please like and retweet the stream, greatly appreciate it. Dun, 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 dun. Why is it called Live with Restream? Can I change the name of that? Oh, I can. Let's go. Credit Spread Seminar. Save. Let me refresh on Twitter, see if it does it. It says Live with Restream. I wanted to change the name of it. I ain't closing it down and open it back up, so it's just a title. All right. Please like and retweet the stream. I'm sending out the link right now in Discord. So, I appreciate everyone coming to hang out Saturday morning. Easier to do it on a Saturday morning. For me, it is at least. I got the grandparents coming over to watch the kids in a few, and then we're going to go ditch the kids and go have fun without those little bastards for the day. But market hours, 9:30 to 4, and then after 4 o'clock, finishing up with work, doing a recap, closing down, the accounts, taking care of questions or anything that's going on in the Discord, and then 5 o'clock rolls around, dinner time, get the kids ready. After that, shower, bath, the whole thing. Like when the market's done at 4 o'clock, like I'm busy until the kids go to sleep, and then I'm in bed by like 10. So there's literally nothing else I can do. And then I'm up at 7:30 taking care of the kids, have breakfast, and then pre-market stuff, and then trade the opening morning session for the rest of the afternoon. So literally Monday through Friday, from the time I wake up until the time I go to bed, I'm always doing the same thing just every single day. So had no choice but to host this on the weekend. So told her to take one of those kids' toys away. That was so fucking loud. All right, so we're gonna go ahead and jump in here and get started. So this class, I said 9 to 11. Is it going to run till 11? Probably not. But if you have questions, then maybe, which I'm sure most of you guys will. So I want to do something real quick. You guys should be able to see my trading view screen. All right. So what I'm going to do is I'm going to replace the trading view real quick, and I'm going to go to Webull and see if it changes for you. So now you should be able to see my brokerage right here, my Webull app on the screen. Let me know in the chat if that transitioned smoothly, if you guys can see that. It just went from trading view to Webull. I just want to make sure that that worked, because that's what I'm going to be going back and forth just between those two. Okay, just between trading view and Webull. I'm going to be using both of those because I'm going to show like the technical analysis and some things that I look at, and I'm going to type on the screen on trading view, but then obviously pulling up contracts and everything, I'm going to do it on my Webull account there. So you should be able to see Webull here. You got Tesla and the option chain over here. My chart setup and watch list over here. You should be able to see all that. Someone said, yes, takes a little bit for it to buffer for better quality. Yeah. Restream. I don't have the pro version of Restream. I'm probably going to get it just eventually here soon, once I have my own office space and a complete setup. Most likely I'll just end up using Restream a lot more. Yeah, I mean, so I'll be able to do this real quick too. So like that's Webull right there, and that's the options chain, right? So now I can do this. It's gonna pull it up a little bit more. So it's gonna zoom in. So you should be able to see, maybe it clears it up a little bit more. But and then like I'll go over here. So just for example, we'll go pull up SPY. We'll look at the options chain for Monday. Go vertical, whatever it is, right? So we'll go here. So you guys should be able to see this right here on the screen. You should be able to. Oh, is that a separate window? Maybe it won't allow that to pull up. There's always something, right? Like there's a little extra window that's right here, but you probably can't see it. Let me see. What does this do? Fold the tab, sticky on top. I don't know what the fuck that means. Can I toggle that over to a different setting. Let's see. Replace screen. I can just share my entire screen. That might be the best thing to do instead of doing the applications. What's up? What's up? We'll just do that. Let me see if this works. I'm just going to do the entire screen. So I'll be back and forth. You'll see like your chat here on Restream, but if I go over here on here, and now if I go here and pull up the options chain, you see this order right here. You should be able to see this order. It's just extra window. I can also check it on my phone. Let's see. It's just extra window. Oh, I see it working on this side. So that might be easier. I might just share the entire screen. Yeah. Cool. All right. We're just going to do that. All right. Easy day. All right. So we're going to go ahead and jump in here and get started. So make sure if you do have any questions, what's up? Yeah, what's up? What's up? So if you do have any questions, please. Oh, can I still do this? Oh, shit. What's up, motherfuckers? Change that back. I'm just messing with Restream. So, let me see if I can, what's up, Charlie? Let me see if I can change that real quick. Oh, there we go. Okay. Can I do this? Oh, I can put myself in the bottom. Now you can see me. What's up? All right. We're good. We're good. All right. If you have any questions whatsoever, please use, if you're on X, just go to the live chat. Don't use the comment section. Because I have my phone right here. I'll check that periodically, but I'm going to try not to. So just click on the stream. When you're watching it, there's a live chat little bubble at the bottom. Click on that. That's going to auto-populate right over here in this chat. So if you have any questions, just let me know. I'm going to be over here on TradingView, right? Then we're going to go over here to Webull, look at the brokerage shit, and then I'll toggle back over here to the Restream and look at your guys' messages. So I think we're ready to go. I think we're good. It would have been a lot easier if within the Webull application, it wouldn't have the separate tab that pops up be another completely separate window that you guys couldn't see. So fuck it, we're just going to run a full stream setup here of the screen. So if I get weird text messages or something, it's going to pop up in the top corner. Just don't read it. So it's okay. Airbnb. So this is not what this class is for, unfortunately. I'm not going to be doing technical analysis on a bunch of different names for you guys. That's not what this class is about. I do that every other day, Monday through Friday. I'm going to do it tomorrow on the Sunday night live stream. I'm going to do that there. This class is completely separate. It is going to be based on my credit spread strategy, on how I use credit spreads to trade same day expiration, which is 0 DTE contracts. Going to trade 1 DTEs for like swings, but also just like same week. So, if it's Monday, you can open up a credit spread for something on Wednesday or Friday. It really just depends on your technical analysis, and that's something that we're just going to cover here. It's just like anything else, right? You take a trade on NVIDIA, right, intraday. Or you might want to take a swing on the video, right? So you might swing some calls or you might trade calls intraday. You can do the same thing with credit spreads. You can day trade a credit spread. You can also swing a credit spread if it's a bullish position or a bearish position, just like swinging calls and swinging puts based on your technical analysis. You can do the exact same thing with a credit spread, and that's what we're going to cover here today. Because what's wrong with seeing something in a clear uptrend, right? Something's in a clear uptrend here, so you decide to take calls like right down here, right? So with taking calls and you get a nice move intraday, and say you swing some runners and then boom, like the next day, 2 days, it goes up 200-300%. Fantastic. At the same time that you decided to take these call options here on the video and a day trade turned to a swing trade, whatever it is, why not sell a put credit spread for the end of the week or for tomorrow, whatever it is? And as long as NVIDIA remains higher on the stock price, it can go flat all at once as long as it remains higher than where essentially you entered in, which I'm going to show more about that. That credit spread is going to be 100% full profit. So it's just an extra tool. So yeah, while you're swinging or trading calls on your cash account, why not open up a put credit spread on that same name on your margin account? Make more money, right? So yes. So it should, I say should because technology is a pain in the ass. It should record this entire session. Okay. So the tweet for this stream should be saved on my profile. That's why I tell everyone, please like and retweet the stream. Let everyone just be able to have access to it, just to get it out there, be able to find it. But you should be able to come back to my profile later on, and where the stream is running at right now, like the actual tweet itself on my profile, when this is over, it should leave it there with the link. And you'll click on it, and then it plays like the past recording of it right there on your screen. Also, if you go to my profile, I have my link tree where I have everything in there. Go to like my Discord, my WAP store to buy my shit, the KC Algo, and then all my social media stuff. You got Instagram, TikTok, YouTube. If you go to my YouTube channel, which everyone should like and subscribe. If you go to my YouTube channel, you go look at my videos. There's a tab on YouTube called like Live, and it will show you all the live streams that I've done connected to YouTube. This stream right here on X is also live stream right now to my YouTube channel. So you'll be able to go back onto my YouTube channel and watch it there as well. So it should be in two places. So I don't rely on just one. I make sure I got two options just in case one of them fucks up. So we should be good. Keith, what's up, my brother? Keith's amazing. Like and subscribe. All right, we're going to go ahead and get started. Okay, I'm going to talk about something called credit spreads. So the issue with credit spreads is people make it very difficult to understand, and it can be very difficult to understand. So I'm going to explain it. I'm going to explain a credit spread in the simplest and easiest way possible that I can, like dummy it down. But then I also have to throw in like where the hard part comes in, trying to understand why they are the way that they are. And it really comes down to the math on it. So I'll do a lot of things. I do not use Webull Desktop whatsoever to trade. I hate trading on Webull Desktop. So I'm going to try my best to do it on here. I'm also going to pull up my phone just in case. But work with me here because I don't trade on a desktop. I trade on my phone. Applications on mobile are so much easier and faster for execution for me. So let's go ahead and jump into credit spreads. So everybody knows that you can buy options and sell options every single day, right? There ain't nothing. Everybody knows, right? So, for example, I called out some SPX puts the other day on live because of this head and shoulders, right? I had a little trend line, whatever, I took puts right there. Took puts right there on this next 5-minute long top wick right here. Got a flush right afterwards, right? Everybody can see that. Everybody can do that, right? This ain't what credit spreads is about. It's not because I see that I decide to take a credit spread to go to the downside. That's not what this is about. Credit spreads is like, honestly, for me, it's almost like a set it and forget it kind of thing. Once you get used to it, you'll be able to figure it out. So we're going to talk about two things, okay? And it confuses people sometimes, but I'm going to try to, again, make it easy as I can. So credit spreads. There are two types of credit spreads, okay? There's two types. You have a call credit spread. When you think calls, what do you think? Think bullish. It's going to go up, right? Credit spreads are the opposite, okay? Because credit spreads is an option selling strategy, okay? And then you have put credit spreads. You have call credit spreads and put credit spreads. So a call credit spread is a bearish position. I know. Weird, right? Calls bearish? How does that fucking make sense? Because it's credit spreads. Okay. So credit spreads are an options selling strategy. Okay. So normally, right, if you want something to go up, you buy calls. So I see SPY going up. Just hypothetically work with me here. You see this chart, SPY is going up. So what do you do? You buy calls, right? But I misspelled the word credit over here. That was my freaking OCD kicking in. All right, SPY is going up right here, right? Just for example. And if it's going up, what do? You buy calls. But we're not buying options, right? We're going to sell options. So if buying calls is normally bullish and options selling, okay, credit spreads, is the opposite. What is the opposite of buying a call? You flip it and you sell a put, okay? It's the exact opposite, okay? So if you want SPY to go higher, you buy a call. If you want to take a credit spread trade on SPY and you want to go higher, you sell a put. You don't buy a put, and this is probably going to make it a little bit easier. Because if you bought a put option, what does that mean? You're expecting it to go down. So instead, what do? You sell the put, okay? So, and also a credit spread is it's a hedged position. You don't just sell one put option because that's something else that we're not going to go into. That's called a cash secured put, which works as well. That's not what this session's about. That's when you just sell a naked put. You just sell the put contract and you don't hedge it with like what a credit spread is. Okay. So credit spreads, call credit spread is bearish. Okay. A put credit spread is bullish. You're going to sell puts because you want to go higher, bullish. You're going to sell calls, credit spread, because you want to go down, bearish. Okay. So I do this on same day contracts, next day contracts. And again, you can also do it on weeklies, just like swing trading. So it's just like any time frame. Because if the daily on Monday and Tuesday looks bullish, you can open up a credit spread for Friday. You can sell a put credit spread, which is a bullish position, right, for Friday expiration, which means you think this stock is going to continue to trend. So Tesla, for example, Amazon, for example, whatever it is, had amazing weeks, right? They've just been trending. There's a 4-hour chart. It's usually what I'm going to end up looking at, right? Look at this. Look at this trend, right? Just trending. So let's go to Monday is right here. This is, where's Monday? Monday's open is right here. So Monday's open's right here. So you see it goes up and it comes back down. This is Tuesday at the open. So you're like, man, this is looking good here on the 4-hour. It's just making higher highs and higher lows, right? We're trending to the upside. So since it's Tuesday, I can open up a put credit spread for Friday, which would be this expiration up here. I say none of this has happened yet. I'm going to open up a put credit spread for Friday, which means I expect Amazon to, continue to be higher than where it is right now, at least. So if it's at 212, we're going to go over strikes here in a second on how to open up the put credit spread that you would swing for this. You want it to stay above, where you entered into this put credit spread essentially. And if it goes higher, you're just going to keep on collecting and making more money. Okay. That's essentially what you can do for swinging it. Day trading options or credit spreads, sorry. Jesus, look at all this shit. All these levels on my chart. I got way too many levels on SPY below. Also, I guess I'll cover this too. If the stock is going completely sideways and doing nothing, you can open up a call credit spread and a put credit spread, which is something called an iron condor. Okay. That means it's locked and it's chopping within a box, which is fantastic because if the market is just going sideways and it's not doing absolutely anything, you can bank on a call credit spread or a put credit spread, either one, if it's just going sideways. Because if it's not trending in either direction, it's just going to essentially burn all the premium on those contracts, which is good for option selling. We'll cover that as well. But if it's going sideways, you can open up both sides. And as long as it stays within your range of your credit spreads, you're going to make money on the call credit spread and the put credit spread. It's like double dipping, called an iron condor. All right. Seems scary because profit is less than the loss. Yes, it can be. That's another thing with credit spreads. So in order to take a credit spread, you have to put up a certain amount of collateral. So the thing with credit spreads is, especially if you use Robinhood, if I had a Robinhood open account for credit spreads, it would be pretty easy to show this. But Robinhood will show you when you open up a credit spread, the chances of profitability. And most of the ones that I'm going to cover here, which how I trade SPY and Qs on it, if you open it up on Robinhood and you go put that trade in, it will tell you what's the chances that this trade is going to be a profitable trade. And most of the time, they're 88 to 90%. So that's really good if your trades are winning 90% of the time. Downside is when you normally trade call options, right? You can only lose 99% if you held till zero, right? You buy a call option on Tesla for 150 bucks. Doesn't go your way. It starts to go down 50%, 60%. You're like, fuck it, just let it go to zero. It goes all the way down to zero. You lose $150. Credit spreads ain't like that. Credit spreads will keep on going lower and lower and lower and keep on taking money if you hold it. It will not go minus 100. It will go minus 200, 300, 400, 500, 600. So if you wanted to make, 200 bucks or whatever, and you were willing to lose, say $200-300 as well at the same time, it goes minus 100%. You're going to be down like 200 bucks. If it goes minus 200%, 300%, 400%, it's just going to multiply that. And you're just going to keep on losing. That's why you have to have a really, really solid strategy with credit spreads. Now, with credit spreads, with the way that I trade them, the chances of it being a profitable trade, with it being 90%, you win majority of the time, which is good. If you do take that loser, my stop is usually around 200 to 300%. So that means if I make 2 to 3 more trades, then I'm back to essentially where I was before. So if I made 10 great trades in a row, right, I'm up $1,000. Make that one bad trade or the market doesn't work out in my favor, and I lose 200-300%, right? So now I'm going to go down, say $300 in the account, right? So now if I take another credit spread, I'll make $100. Make another credit spread, make another $100. And then my third one puts me back at 1,000, right? So that's the weird thing with credit spreads, is that if you're not careful, they can fucking wreck you. You have to have rules. But again, one of the strategies I'm going to cover, the chances of profitability with those are, again, 88 to 90% majority of the time. So, Eva, what's up? Yeah. See, Mitch already knows you can roll credit spreads. Yeah, you can turn them into cash secured puts. If you have, like right now, I just bought a bunch of shares on Rivian as well. I just started a position with that. You can start doing something called the wheel strategy. Mitch, we're like going to be way up there talking about that. These people's minds are going to be blown. We start talking wheel strategy about selling cash secured puts and then getting shares for equity in our accounts and then selling covered calls to collect premium. People are going to be like, what the fuck are they talking about? So eventually that class will come. Just got to start with, regular credit spreads. Would you consider hedging it with a longer dated call and put? 100%, you can absolutely do that. You can also hedge it with another credit spread too. Like I said, you can have that iron condor. If you're in a call credit, because we'll just go ahead and jump into it, okay? We're going to go ahead and answer that. If you're in a call credit spread because you think it's going down, if it starts to work against you and the stock is going up, you can open up the put credit spread, okay? And now when the put credit spread starts to gain value while your call credit spread is losing its value, if it hasn't reached your stop yet, say you're down 75% on your call credit spread because you want the stock to go down, but it's going higher, okay? And you're getting antsy about it. If you want to hedge, okay, you can open up a put credit spread at this time, which means now you're going to trade in the direction that you want it to go. You open up the put credit spread as your hedge. So now you're going to have your iron condor. So now if at any point in time, if it continues to keep on going, and your call credit spread goes over like that minus 100%, whatever it is, you could end up cutting it if you'd like. You have your put credit spread now, which will cover if you size the exact same on it. It would cover the loss on the other one and you would be flat, perfectly fine. Or the thing is, if it doesn't go down to your stop, like my stop is usually 200 to 300%, and that's because even if it goes minus 200%, that doesn't mean my trade has been invalidated or the trade is wrong. That's just because the premiums are increasing and I don't want them to, because the point of a credit spread is for it to go to $0. I'm going to explain that why here in just a second. So if it goes minus 200%, okay, keeps on going lower, but I open up that put credit spread as the hedge. Now that one is up 100%, right? Now say it finds some support and it bounces like this, for example, comes all the way down here because you were bullish at the open. Let's say you opened up a credit spread right at the open. You opened up a put credit spread, goes all the way up here, right? Looking good. And then it comes all the way back down here. So now your put credit spread that was green, say your put credit spread is now going red, right? So if you were to open up a call credit spread because you think it's going to go lower, you could absolutely do that. But the second that thing finds some support and it bounces, it's going to go from minus 40%, go back up plus 40%. So you can always hedge it with another credit spread. And the thing is, even if it goes minus 200% and you open up the other side, if it finds that support and it bounces back up, just like this, your original position is going to go back green, okay? Your new position, now that you open up as a hedge, might be slightly red. Look what happened again. It came back down. Look what happened again. It bounced back up. SPY opened up here. SPY closed like at the exact same price. So what does that mean? It means your call credit spread, your put credit spread that you took in the morning on the move up, the call credit spread that you opened up on the way down because you got antsy, you wanted to hedge it. Guess what happened? You got an iron condor, which means it's stuck in a box that you want to stay in. So now what happens at the end of the day? You held on to both of them. They both made money, okay? I know this probably all sounds super, super fucking confusing. Do you see the Greeks when... Oh, Market Bishop is here. For an iron condor, you can only lose on one side, not both. Yep, 100%. So for an iron condor, it is impossible to lose on both sides. That's why I said credit spreads, it's almost like having a hedge position. So an iron condor, if you decide to open up an iron condor, it's impossible. The only way you could lose on an iron condor is for whatever freaking reason, like Weeble fucked me one time on an iron condor, and that's because Nvidia was about to report earnings, and the premiums right before close got inflated on both sides, calls and puts, And by doing that, it messed with my iron condor. Chances of that happening, that was the one time I've had that happen in the last, I don't fucking know, 200 credit spreads that I've taken. So yeah, Bishop is correct. You cannot lose both sides of an iron condor. One of them is going to win. The difference is how much premium are you looking to collect within your call credit spread and your put credit spread. If you size them the same, if you let one go minus 200% and you sold it for a loss and you size the same on your other credit spread, that one can only go to a plus 100%. So that means on one trade, and we'll just use whole dollar numbers. That means on one trade, if it went 100%, you make $100. On your other one, you sold for your loss during your iron condor because it kept going down, whatever it is, and you just close that one completely. Say that one lost you $200. Now, overall, your net loss is only $100 on this because you had the other credit spread to make up that extra $100 on your $200 loss. So but you're not going to lose on both sides. You're not going to lose $200 over here and $200 over here. It's not going to happen with an iron condor. Yeah, dude. Yeah, I absolutely freaking love credit spreads. And so we're going to go ahead and jump into it. Enough of me blabbing. Yeah, stop loss, 100%. You can always do a stop loss. So this is what we're going to talk about, okay? It's the technical analysis doesn't change, guys. The strategy is completely different, but the technical analysis doesn't change. We're going to jump into it, okay? We're going to do SPY. We're going to open up some credit spreads for SPY. Open up credit spreads. It's Saturday. Market's not open, okay? So you have to do technical analysis on SPY. One thing you can do if you're doing zero DTE options, okay, which most of this is going to be, you can do something called the orb strategy. We're going to use this for an example. Okay. This is the orb strategy. Okay. I'm going to get rid of those other lines because we don't need that. And this is a strategy that I use that can help me. How do I turn those other two off? Price targets. There we go. It's something that can help me identify trend. Okay. So orb strategy stands for open range breakout. You can use a 15-minute orb strategy or a 30-minute orb strategy. Here on the chart is SPY, okay, for the orb strategy. So the orb strategy is open range breakout, which means within the first 30 minutes, you mark the high and you mark the low of that stock, okay? It works on everything, same strategy, okay? Doesn't change. So, which means by 9:30, which is, 10 o'clock, from 9:30 to 10 a.m. So you got the market open at 9:30, you got 10 a.m. right up here. So the highest candle is right there. The lowest candle is actually the 9:30 candle at the open, right there. So this indicator here automatically does this for me. If you don't have this indicator, you would just be able to mark that yourself. So like, okay, 10 o'clock is in. What's the high and low of the day? The lowest so far is right here. The high of the day is right here. What does this mean? This means that if you start to see momentum, okay, or any kind of sign that, you have like that break in base that you want to see, that we're trending in one of these directions, okay, this is where I'm going to open up my credit spread to enter into that position to go with where SPY is moving for the day. So that means SPY right here at 10 a.m. and it starts to consolidate right up here. You see this like little pennant that it made here that everyone was probably watching at the open, right? That little pennant, if it broke to the upside right here, if it broke to the upside, it comes back down, hits the orb high right here and holds and starts to go higher, we're trending up. So we're trending up. What do I want to do? Okay, I want to open up a credit spread. What's a bullish credit spread? What does it say? A bullish credit spread is something called a put credit spread. Okay, that's how I would have played this. But SPY came down. Get rid of this. SPY came down, went back to the orb low. It bounced and stayed in within this all day. So when you see this chop sideways, this is where you open up that iron condor, because then you can make money on both sides. SPY didn't really go anywhere above the orb high. It went briefly below the orb low and just consolidated, came back up, went back down, and then closed for the day. Nothing too interesting there, okay? But this indicator, I'll actually pull it up right here. It's an amazing indicator, guys. It's free on TradingView. Give me 1 second. About this script. Boom. Here you go. Orb with price targets. Okay. Look that up on TradingView by Get That Cash Money. Believe it or not, when I actually started using this indicator, I talked about it on Spaces and I posted about it. And the creator, he's actually on X. His name is Still Get That Cash Money. And he sent me or commented on it. He was like, I created this thing a few years ago and I still use it to this day. And I was like, dude, it's a fucking awesome indicator. I love it. I'm glad because I was marking these orb levels manually every morning on my chart. He's got a fucking indicator that does it for me. So easy day. Okay. So this strategy, orb strategy, this is going to help me determine, okay, if we're trending and where and when I'm going to enter into these credit spreads. What would you do if you had opened up a put credit spread on SMCI a few weeks ago when it dropped 30%? You would have got your ass handed to you. Can you adjust the time? So the orb strategy, honestly, it's 15 and 30 minute. And yeah, you can adjust it on here. You go right here. Go to see where it says period, minutes at the top. He does 5, 15, 30, and 0. So yeah, you can do 5 minute. You'll see the chart. See how it automatically adjusted right there? You do 15 minute. I think it's the same orb. Yeah. 30 minute. And then it changed it back. So yeah, you can adjust the time on it right here within the indicator. It's freaking amazing. Okay. So now let's talk and enter into a credit spread. Okay. But someone said, can you do a stop loss? Yeah, you can. In your broker, you can put a stop loss in on your trade just like you can any other account. Let's find some day that's not like, look at all these choppy days on SPY. What about Qs? Qs is probably a little bit better with trendy. So look at this bull flag right here, and then I think, was that FOMC minutes that day? One of them was. Right here. This is a good day. Here you go. This is great. This is beautiful. This is the chart that you want to see for anything, whether you're just trading normal options or selling credit spreads, okay? So, for example, QQQ opens up, okay? I got the orb indicator on. Look at this back test. This is why the orb's amazing. Look at this huge red waterfall right here. How many people decided, oh man, look, it kept on topping out right up here, big resistance. We're flushing. Let's go back down the low of day. It hit this spot right here, instantly reversed, and then made a new high day. People are like, man, what the fuck happened? I just got crushed on these puts. I thought we were going to sell off. Fucking orb strategy, man. These levels work. Oh, it's freaking awesome. So, anyways, orb strategy, 0 DTE. 0 DTE. This is what I do 99% of the time. Okay. You got QQQ, opens up, goes down, comes back up. Hits up here, comes all the way back down, goes straight back up, and it chops around for a while until it finally gets some candle closes, above the orb right here, and then it goes higher. Cool. Comes back down, still above the orb, okay, right here, and then goes back up, right? So we're trending. Let's just say we're trending, right? We're trending. When it breaks above the orb, and I'm like, this is my confirmation that we're going higher. It's looking like we're going higher. So let's mark right here. We're going to enter in at, and we're going to say it's at 521. 521. That's where QQQ is at when I decide, based on my technical analysis, we are closing above pre-market high, okay, on this 5-minute candle right here. Just closed above pre-market high. Just retested this 521 area back on the 30-minute orb, and we're pushing higher, right? So another thing before I do cover this portion, because I completely skipped over it, on why options selling is amazing. So when you buy calls on QQQ, you know how your premium goes up and that's how you make money. Since this is option selling, you want the opposite to happen. So you're going to open up this credit spread, and we'll go over this example right here. Say you're looking to make $100. So the thing is I'm going to sell those puts, right? I'm going to sell those puts to somebody, which means, think about it this way. Somebody's on the opposite end. They want QQQ to go down. So you're going to sell that put to Joe Schmo, right? He's bearish on QQQ for whatever reason. So you're going to sell this put to him, and he's going to hold that put. And as the market goes higher, as QQQ goes higher, what happens to his put? Say QQQ is at 521, and say he's in 519 puts, right? Say Joe Schmo is in 519 puts. You sell that to him. You sell him a 519 put, right? For $50, okay? Essentially what happens is, as QQQ goes higher, the $50 that his put was initially worth, as it goes higher, what happens to your put if QQQ goes higher? You lose money, right? If you're the person in the put credit spread, you're taking that money from Joe Schmo, okay? As QQQ goes higher, that put that you sold him, that he's bag holding, it's losing money. So essentially, he's paying you that freaking money. It's like a bet, right? He said QQQ is going to go higher. I'll bet you $50. You're like, cool, I'll take that bet. You sell that put to him. As it goes higher, he's losing money. He's just slowly handing it over to you until by the end of the day, if QQQ does not come down to 519 to get his 519 put in the money, his options contract on QQQ is worth what? At the end of the day, on a 0DTE option, what's it worth? $0. It was worth $50 at one point, right? So what does Joe Schmo have to owe you at the end of the day on that put? $50. That's how this, essentially, the strategy works, just as a metaphor, is you're selling that option to him, to Joe Schmo, okay? He's betting that it's going to go down. You're like, I think we're going to go up or go sideways. So that put, for your put credit spread, right? If it gains value, he wins and you lose. Now you have to pay him money, right? Because if QQQ comes down and his 519 put from $50 goes to $100, right? He's up by $50, which means now you owe him $50, which means your put credit spread, right, is going to be negative. Instead of making $50, now you got to start paying $50, right? That's where like that minus 100% now comes in, right? It's kind of how it works. But at the end of the day, if that 519 put is worth $0 and 0 cents at the end of the day, it expires worthless, which is good. That's what you want your credit spreads to go. That's the goal, is these things to be at $0 and 0 cents. That's essentially what it is. And that's how premium and like theta burn works. That's the only Greek you kind of need to worry about is theta. If you guys don't know what theta is, it's kind of like the decay of your contracts. That's when like SPY and QQQ are chopping sideways, and that's why an iron condor works beautifully. So here for QQQ, for example, you see how QQQ goes higher, comes back down, goes higher, comes back down, goes higher, comes back down. If you're in calls or you're in puts on 0DTE options, you can't catch a fucking break. You're gaining a little bit of value, you're losing a little value. Gaining value, you're losing value. Everybody's just fucking worried and chopping around. Because, and as time goes on, it goes up and down from 10 o'clock until 2 o'clock. For 4 hours, QQQ gets stuck in this little range. Guess what happens to the value of these 0DTE options? As time goes on, closer to the end of the day, and the market's not trending or moving, all those contracts lose value. If you're an option seller and you're in credit spreads, that's good. Because what did I just say? The goal is them to lose value and go to zero. So if that's happening, while everyone else is getting stuck in this chop, they're like, man, I keep on getting burned on calls, keep on getting burned on puts, I can't figure out. You're just over here selling a credit spread. You're like, I don't fucking care right now. It can go sideways all at once. And those contracts, they're going to keep on losing value. And those people that are holding those contracts, that's the thing. The people that are bag holding those contracts, wanting it to keep on moving, and it's not moving in their direction and they're losing money on their options, you're the one that sold it to them with this credit spread strategy and taking money from all of these people that are just bag holding these freaking 0DTE options that are losing value. That's essentially the goal for this strategy and everything that I'm going to be talking about. Yeah, theta decay. So we're going to do a put credit spread. Yep, right here. So, for example, QQQ is right here at 521. Breaks pre-market high. We're like, cool. This looks good for a trending day upside. Open range breakout. It is breaking range to the upside. So this is what happens. This is how you open up a put credit spread again, because that's bullish. That's what we want to do. QQQ is at 521. So what do? I zoom out and I'm like, what's big support on QQQ? If QQQ comes back, where are we at? If QQQ comes back, where's big support? Big support, previous day high, and this low right here, right there. I see that area as big support. And then you essentially find, and what I do is I find another level of support right below, or it's usually like $1 or $2 outside of it, which we're going to talk about, like the spread and the width on it, for example. But we're just going to say this area right here. That's our support. So here we go. So what I'm saying is QQQ is up here at 521. For whatever reason, if it decides to come back down into the orb and make a new low of day, next big support that I see, you'll see why. I see this right here. Resistance and a big buy right there, right? So I'm going to mark this key level. I see a big level of support, which means I can expect it to bounce there, okay? This is going to help me decide the strikes for my put credit spread, okay? Essentially, this is what I will do. QQQ is at 521. So I don't see, even if QQQ comes all the way back down, makes a new low of day, I don't see it going below 518. I think that would hold by the end of the day, based on whatever technical analysis that you're seeing, right? So I am going to sell a 518 put. And I'm going to go $2 downside right here, okay? And I'm going to buy a 516 put. So do not get this confused. You will fuck it up, okay? You always sell the strike that is closest to the stop price. So by that, I mean, QQQ is at 521 when I decide to enter into this put credit spread, okay? What's the closest strike between 518 and 516? Which number is closest to 521? 518. So that's the put that you sell, okay? But credit spread is kind of like a hedged position within itself. It's called a vertical. So you can't just sell, you can just sell the 518 put. But in order to do that, that's called a cash secured put, completely different strategy. You have to have enough money to own, 100 shares of QQQ, which most people don't. So you don't, and that's another thing. People think in order to open up the credit spread, you have to own the shares for that stock, right? No, you do not. Not with this, because you're going to buy this 516 put. You don't have to own shares for QQQ to do this. So let's just say 518 puts are worth $20. On the options chain, it's always by cents, right? It always says 0.20, 0.50, 1.5, right? 1.5 is 150 bucks. 0.20 is 20 bucks. Obviously, 516 puts farther out of the money and it's cheaper, right? 0.08, which means what's the difference between those two numbers? What's 20 minus 8? $12. So that means if I sell a 518 put on QQQ and I buy a 516 put on QQQ, I am now in a put credit spread. I'm in this put credit spread. The premium that what it cost on that 518 put, it costs $20 on that contract. The 516 put is $8. When you sell the 518, you buy the 516. This opens up the put credit spread, okay? You are looking to collect the difference between those two strike prices, which means your put credit spread is worth $12 for every one, essentially, think about it this way, every one contract. So if I decided to do that by 10. You know how when you buy calls on NVIDIA or Tesla, say you buy call options on Tesla, $500 calls, right? And they cost $150 for every one contract. If you want to buy 10 contracts, it's going to cost you, whatever that math is, $1,100, $1,500, whatever it is, right? $1,500. Same thing. For this one, it costs $12 every one contract. So say, just like you would buy, 10 call options on Tesla, you're going to buy 10 put credit spreads. You're going to sell, because options selling. You're going to sell 10 contracts or 10 put credit spreads, which means you are looking to collect/make on this one is $120. So, long story short, this is kind of how I think about it. At the end of the day, for QQQ, you do not want the strike that you sold, that 518, you do not want that to go in the money. If that shit goes into the money, it gets bad. Okay, that's where you get your ass handed to you. Okay, so at the end of the day, which is up here, this is at 4 p.m., right up there. That's at the close. I'm saying by the end of the day, on this credit spread, QQQ is going to stay above 518. If it does, I make $120 because whoever was bag holding the freaking puts on QQQ and let them go all the way to zero, they're paying me the freaking money on that bet that they lost, right? I'm going to make $120. That is the simplest, without going into, and I know probably a lot of this sounds super confusing, and I'm trying to make it as easy as possible because it is a lot. It's super confusing. Go watch a YouTube video or read about credit spreads online. Your mind is going to be blown. So freaking difficult to understand. So essentially, what you're saying is that when QQQ breaks above this orb strategy, and it tells me that we're bullish for the day, right? I take a lot of things into account. What's NVIDIA doing? What's Tesla doing? What's tech doing? What's the Mag 7 doing? Is everything running? Is Amazon ripping? Microsoft, Google, are all these names strong? Is that why QQQ is strong today and it's going green? Cool. That makes me feel better about opening up a put credit spread if the market is trending and going higher. And what I'm doing is I'm going to open up this put credit spread and I'm going to say, at the end of the day, at the end of the options contract expiration, and like I said, you can do these on the same day. I can do these for tomorrow. I can swing these over a few days. And we're going to do another example on how I would swing something for the week, because this is just a zero DTE, which is the highest risk and most volatile freaking credit spreads of all time. But they're super cheap. They cost a little bit of collateral to do, but chances of profitability on these, are a little bit higher. And essentially what I'm saying is at the end of the options contract expiration, which again, these are zero DTEs, and it's the same day at 4 p.m., 4:15, because buying QQ trades last 15 minutes past 4 p.m. If it's above 518, I make money. So it closed at what? 523. This is where it closed at, was 523. My put credit spread is $5 out of the money. If it's $5 out of the money at expiration, it's worth $0, which means I collect the full $120 that those people decide to bag hold those options that I sold to them for this credit spread. Okay, that's essentially how a credit spread works. So what I'm going to do is I'll pull up Webull real quick, and we're going to look at, we'll look at QQQ. It's perfectly fine. We'll do QQQ. We're going to look at Monday. So another thing to do with credit spreads is, since I sold that 518, did I have to do the 516? No, I could have done the 517. But think about it this way. This is what you have to take into account. It's math. This is all fucking math. It's really all it is. It's math, and I hate math. But when it comes to money math, it makes me a little bit more excited. I can do 517s instead of 516s. But think about it this way. If I did a 517, because it's closer to 521 or 518, what's the price of that 517 put, right? If the 518 is worth 20 and the 516 is worth 8, what's the 517 worth? Probably going to be somewhere in the middle, right? Let's say it's worth 14. Okay. If I were to have done that credit spread instead, look at the difference. What's the difference between these two? The difference between those two is 7. So now how much money I make changes, because now the difference between that one is $7. So if I do times 10, how much money am I going to make on this one? $70. Versus if I did the 516, which was at 8 with my 518 for that put credit spread, right? The difference was 12, where I make $120. You see how, depending on what strikes you select, changes a lot of things. It changes how much collateral you have to have in your account to take this trade, which we're going to talk about here soon. It also changes how much money you can make on this put credit spread. So what that's called is called width. It's the width between the two strikes to take this credit spread. Between 518 and 517, what's the width? By width, I mean dollar amount difference, 1. Because from 518 to 517 is a $1 width. Between 518 and 516, it is a $2 width, okay? The larger your width in your credit spread, from 518 to 516, go down to 518 to 515, right? The larger that width, the higher the premium you can collect. The difference is, the higher the premium you can collect, the more collateral you have to put up in order to make that premium. By collateral, again, I mean the money in your account, because there's a big math algorithm that we'll try to explain as simple as possible on how it calculates that for the amount of money you have to have in your account to take this trade, which will go with your risk to reward. How much can you potentially lose on this trade, and how much can you win on this trade? So if I went to a $3 width, right, from 518, that means I would go down to 515, all the way down here, right? The 515 put is super far out of the money. What's that thing probably worth, since it's all the way down here? It's probably worth like $3, right? If that's worth $3, the 515, and I'm still going to do the 518 up here, right? What's the difference between 20 and 3? The difference is 17, okay? If I do the same thing, 10 contracts, what's 10 times 17? $170. That's how much money I'm going to make. Do you see how it just keeps on changing, how much money I'm going to make? And then if I got rid of the 518, we went super far out of the money, right? We did the 516 put and the 515 put. That 516 was worth 8. The 515 is worth 3. What's the difference between those two? $5. If I did 10 contracts, how much am I going to make on that? $50. There's so many different ways you can work these credit spreads. But do you see the reason on this, though? You see how I went from 518 to 516? I could make $120. But if I go super far out of the money, I make less. I'm only going to make, if I do 516, 515, the difference between those premiums is 5. I'm going to take 10 credit spreads for that. I'm only going to make $50 instead of 120. The difference is your risk goes down potentially, because now instead of you saying, if it comes all the way back down to 518, by the end of the day, That's where my stop, where I would want it to be, has to hold above 518. I'm saying, now I'm giving it 516. We're going all the way down here. Let's go all the way down to 516. 516 is way down here. So now think about it this way. This is where like that Robinhood math kind of comes in, and they'll tell you on your Robinhood account, right? The probability. What is the probability? What's the chances that QQQ, when you enter into that put credit spread all the way up here, when you buy that put credit spread all the way up here, what is the chances that QQQ flushes all the way down to 516 by the end of the day? What's the chances of that, right? It's not likely. So what's the higher probability that you're going to win on this 516, 515 put credit spread? Pretty fucking high, because what's the chances this thing's going to fall off $5 out of nowhere in the next few hours by the end of the day, all the way from 521 to 516? Not likely to happen. So my chances of winning on this trade is probably like 92%, right? Which is good. And obviously it went all the way up here to 523, which means I'm going to make money. So there's so many different ways to work credit spreads. You can go super far out of the money and get really, really cheap, and only collect a $5 difference, get 10 contracts, make $50, right? You can go a little bit higher, which increases your risk, right? If I did the 518 and 516, the original one, and that one was 20 and 8, I believe, right? That increases my risk, because instead of it coming potentially all the way down to 516, I'm going to say 518, so shorter range. So there's a higher chance that could happen versus all the way down here. So because of that, I get paid a little bit more in premium. So instead of making $50 at the end of the day, I'll make $120 if that happens, and if I'm right? There's so many freaking different ways to work credit spreads. Optionstrat.com. Bishop just put that in there. I use it every single day. Damn, I had this thing on the whole time. What if it put credit spreads in theory is safer than buying a call? Yeah, Bishop is on it. Bishop's so fucking smart, guys. The reason why he's in my Discord. It's safer than buying a call, as Theta and Ivy crushes are on your side, versus when you're buying a call, Theta and Ivy crushes are against you. 100%. Again, when you're buying a call on QQQ and SPY, as the market is either just not going anywhere and it's fucking with your options and they're not increasing in value, and you're like, man, you know what, close it. This trade is not working out. Market's not going anywhere. I'm done. I'm out of it. Option seller for credit spread, that's what I want, because Theta and the Ivy, that's crushing everyone else. That's benefiting me. Again, this is option selling. We're not buying. It's going to take the money off those contracts and decrease the value, which is what we want, because that's how you get paid on these credit spreads. How much do I need to open this spread? $2,000. We can cover that. Do you have to hold until expiration? No. You can absolutely close this before. The difference is, in order to trade credit spreads, you have to have a margin account, okay? So if you don't know what a margin account is, just look up a margin account versus a cash account. But if you have under $25,000 in your margin account, you are limited to how many day trades you can take. You can only take 3 day trades within a 5 business day period. So if you open up and your credit spread, and say it goes up 75%, and you want to go ahead and close it, that's going to count as a day trade. If you do that Monday, Tuesday, Wednesday, you're done. You're not opening up another one Thursday. You're not going to open up one on Friday. Unless you have over $25,000, then it's unlimited. Your brokerage will let you open and close however many you fucking want. So for me, I deposited just over $30,000 into my margin account. That way I can have unlimited options for credit spreads, honestly. That way I'm not limited to only 3 every single week. For zero DTEs, yeah, I don't use margin. I do not tap into margin. I never have and I never will. I only have a margin account because you cannot trade credit spreads on a normal cash account. They do not allow that. You have to have a margin account to trade credit spreads. That's the only reason I have a margin account. I've never tapped into margin. I don't borrow money. I don't do any of that. I literally just use my cash in my margin account to trade credit spreads. I do not actually use margin. You just have to have, for whatever reason, you have to have a margin account to be approved to trade these credit spreads. Okay. Yup, 100%. Weeble fills are slow. Yes. On credit spreads, they are very slow. It sucks. It sucks. But do they normally fill? Yeah, 75% of the time, I would say. The thing is, too, is it's just like anything else. There's a bid-ask spread on a credit spread, just like you normally would. So, like when you go take an option on Tesla, the bid can be 150 and the ask is 155, right? You can buy the ask at 155 or do a mid fill and try to get filled at 152, 153. Credit spreads are the same way. If your premium you're collecting is 20 bucks, the bid can be 18 and the ask can be like 21 or 22. And you can try to do the midfill around 20, and it might just sit there. You might end up having to change it by a penny or two and drop it down to 19 or 18 to the bid in order to it to automatically fill. Sometimes I do that. Sometimes I don't. 1 5-minute candle can come in, pop it up, fill my order, comes back down, and I'm like, okay, cool. Just like anything else. I'm out of coffee. So essentially, for zero DTEs, I like to let mine expire. I don't close them because think about it this way. Okay, think about it this way. You took your put credit spread here. I deleted all that shit down here because there was a lot of math and stuff in the way. I took the put credit spread here, where I did the 518, 516 put credit spread, right? And I'm saying it's not going to go below 518, and that's the option that I sold, and I bought the 516 to open up this put credit spread. I'll show you how to do that on Webull here in just a second. By this point, right up here, I'm telling you right now, through all of this chop with it going nowhere, the value of that put credit spread is probably very close to zero, which is good. Again, don't think that in a bad way. That's what you want for credit spreads, okay? So by this time up here, I'm probably, honestly, like plus 75 to 90% right now. Now you got just comes down to probabilities and you as a trader. It is 2:30 in the afternoon. There's an hour and a half left. QQQ is at 522 from where you entered in. I'm up 75 to 90%. As long as it doesn't come all the way down here to 518, as long as it doesn't die off the face of the earth in the last hour and a half, I'm going to collect 100% full profit on that trade, right? So if I'm up 75 to 90%, I'm not going to close it because say I paid the spread was I collected 20 bucks, right? And say I'm just going to do $20. That's it, 20 bucks. If I'm up 75%, that means I'm up $15 right now. There's $5 left to go. If it goes 100%, I'm going to collect that next $5. I'm going to get 100% on that trade. If it's at 75, if you like it, perfectly fine. You can close it for 75% and make that $15 if you don't really care about the extra $5. The difference is, one, you're letting some of the profit potentially, because you don't know, but what's the chance of it coming down to 518 in the next hour and a half? Slim to none. So you're going to collect 15 instead of 20. You're cool with the 75% gains. That's fine. In order to close that, just like anything else, your broker is going to charge you commissions and fees per contract. It's a few cents most of the time per contract, whatever it is. If you let it go to expiration, and now we're after 4 p.m., and I never trimmed, and I just let it go until expiration, which you can do. You don't even have to close it. I'm up 100%. Market closes. Guess what happens? Those contracts expire completely worthless, which means after market hours, after 4:15, when market opens the next morning, that entire premium that you're looking to collect, that $20, that profit, it hit your account. You good. You made $20. They put it in your account. You didn't have to close the trade. You did not pay fees and commissions to close that trade. So I'm greedy and I don't like to pay fees and commissions if I don't have to. And again, the probability was in my favor. There was an hour and a half left in the day before these contracts, before this put credit spread expired. What was the chances that QQQ came all the way down here the next hour and a half versus staying either anywhere, versus the chance of it staying from here all the way up to here? And it was already all the way up here, right? What was the probability that QQQ was going to fall all the way down here? Very slim. So why am I going to close it and pay fees and commissions? Is there anything wrong with taking 75% gains and locking that in? Absolutely not. But again, I'm a little bit more greedy. I see the probabilities in my favor. I see I'm going to win this trade full profit. At least I would say I'm 92% sure that it's not going to fall off the face of the earth, and my 518 puts are going to go in the money and cost me money. I think we're going to stay above 518 in the next hour and a half. QQQ's at 522, so just let it ride. And I collect full profit. I don't pay fees and commissions, and I don't have to close it if I don't want to. And if you have under $25,000 in your margin account, remember what I said. You are limited to only 3 trades per week if you manually close them yourselves. If you do not close that trade and you let it go to expiration, you collect that money. It's in your account the next morning. They do not count that as a day trade. So now you're still sitting at 0 day trades. So it's not going to trigger a day trade on your margin account. It's a little way around it if you have under 25K. And that just answered your question right there. I let it expire. Will that count as a day trade? Nope. So you make the same profit whether it expires $1 out of the money or $20 out of the money, essentially. As long as it's out of, because you got to think about it. We'll go over here, go to, it's Saturday. Fuck. It's not going to work anyways. There's nothing on here. If this was yesterday, okay? If this was yesterday and you pulled up SPY options contract at the close, say SPY was at, I don't even know, say SPY was at 600, okay? If you go to the options contracts out of the money, go look at the 598s, go look at 597s, 6s, 5, 4, 3s, 2, whatever it is. Doesn't matter if you're $1 out of the money, $10 out of the money. Every single one of those, I guarantee you, are worth 0.00 or 0.01, which means they're worth 1 penny or $1, or they're worth 0. Usually that's what the bid-ask spread is at the end of the day on ones that expire completely worthless. If it's out of the money, all of those are worthless. They have no value. They were not in the money. They had no value on those contracts. So as long as they're out of the money, they're worth nothing, which is good for credit spreads because that's what you want. That's why I was like, it doesn't matter if you take 518 or 516 or 516, 515. At the end of the day, they all expire out of the money. They're all going to be worth 0. The difference is, and I did the math on the screen, you'll see there, is when you do 518, 516 or 516, 515, the width between those two numbers, that will determine how much money you make. It will determine how much your risk is on there and just the entire technical analysis and the trade it is as a whole. So it just comes down to you as a trader on what your risk tolerance is or what you see potentially on the chart, how far you want to go out of the money to open up this credit spread. How much money are you looking to make? Do you want to make $50? Then you have to go find an options contract that for your credit spread, when you collect that premium difference, say it's $10, you have to be able to buy 5 of those credit spreads to make $50. In order to do that, it's going to tell you how much collateral money you have to have in your account to open that. And that changes whenever you build that specific credit spread, selecting those strikes and those premiums, okay? That just comes down to you as a trader, how much is in your account, how much money are you looking to make, how much money you're looking to risk, almost just like anything else whenever you're buying normal options, buying NVIDIA, Tesla, Amazon calls. It's the same thing with option selling. You just got to find out how much are you willing to risk losing and how much are you looking to make on this specific trade. What do you see on the chart? What's your technical analysis and the reason behind you entering into this trade? It's the same thing. I use the same strategy to buy calls on Tesla, the same strategy on why I would open up a put credit spread on Tesla. I'm bullish both ways, but the thing is, if Tesla slowly grinds higher, or it starts to come down a little bit, and then it goes flat, my call options are going to lose value. My put credit spread, it's still actually going to be gaining value because it didn't go all the way down to my strikes. That's the beauty about put credit spreads or call credit spreads, just credit spreads in general. As long as your options contract don't go in the money by expiration, you win. So if the market goes in your favor, a put credit spread, if it goes up, you win. If it goes sideways, you win. If it goes down but doesn't go to your strikes, you win. That's the thing. As long as this does not go in the money, I win. That's the difference. Because if you were to buy calls on QQQ and QQQ went sideways all day, or after you bought those put credit spreads, or sorry, after you bought those calls right up here at the top, and then it goes sideways, and say QQQ did come back down and close around 519 or 520, whatever it is, you took a loss in your call options. The difference is that put credit spread that you took here at the top, even though QQQ came down, guess what? Your put credit spread actually still won, and you got money from it. That's the beauty of credit spreads. The reason why I love it. If it works in your favor, you gain money. If it goes sideways, you gain money. If it comes back down but doesn't hit your stop or where your strike is to go in the money by the time of expiration, you win. You have a higher chance of actually making money on credit spreads versus just buying the call on QQQ. That's the way I see it. You have a higher probability of winning on a put credit spread on QQQ today versus buying a call option. So that's the thing, is people will just buy the call option on QQQ and then it chops around and maybe it goes down, they lose money. Use the same technical analysis. You were bullish on QQQ, but you open up the put credit spread. If it went higher, sideways, or slightly down, you're going to win. Your call option is not going to do that for you, but that put credit spread will. So it's the reason why I love put credit spreads, call credit spreads, iron condors. Absolutely freaking amazing. Why not sell 518 and buy 480? Well, one of the babies is not happy. So think about it this way. Actually, we'll go ahead and do something similar to that. So width, right? I'm going to show you the width right here. Your mind's going to be blown here in a second. So let's go to SPY. Let's say we're bullish on SPY for Monday, or sorry, QQQ. We're bullish on QQQ for Monday because QQQ is, I don't know, let's go on the hourly. It's trending. Look at that. QQQ is trending. Higher highs, higher lows. Higher highs, higher lows. Say this is a bull flag here on the hourly. We're still holding above the EMAs. It looks good, right? Draw your trend line. I don't know. Whatever your technical analysis is. And you're like, all right, I don't see QQQ going below this support right here. This is around 521 on Monday. So, say right before the close yesterday, right? You got a nice trend line here, higher highs, higher lows, 521, okay? And we'll go down to next level support area. This is 518.52. We're just going to say we'll just do 518. Perfectly fine. We're going to take that put credit spread for Monday. So we're going to go over here. 521 to 518 is a $3 width. So I go to my width, I go to $3. So now we're doing 521, 518. Let's find it right here. 518, 521. So I don't use Weeble Desktop. Let me make sure I can get this right. So remember, you sell the closest one. So it's going to sell you got to make sure you put sell on your order, okay? And it's going to sell the 521s, the closest strike. You're going to buy the 518, okay? So if you, does it tell you it puts it down here at the bottom. It automatically does it for you. I want to see if it would show the difference between the two. I would have to do another chart. So it goes ahead and tell you right here. The bid is 12, the ask is 14, the mid price is 13 bucks, right? So we're going to say 13. So let's say 1. I'm going to take 1 put credit spread. So I'm going to open up this credit spread on QQQ. What I'm saying is I'm going to sell 521 and 518. And by expiration, I don't want this 521 to go in the money. So on Monday, if QQQ, what I'm looking for is to hold above this trend line. If it breaks the trend line, okay, I still need buyers to step in maybe around this previous area of support, 524, right? Maybe I want that to hold. If it breaks that, it might send my 521s in the money. I got to readjust, maybe open up a call credit spread to be an iron condor. We'll cross that bridge when we get there, right? But as of right now, I don't see QQQ falling below 521 by Monday. So, Jesus Christ. So I'm going to sell the 521, buy the 518. I'm going to put credit spread. That's it. And it's 12 bucks to open this up. That's the difference. And I wanted to show it on there. I'll have to go back to the other one. But that's the difference between the 521 and 518. So the 521 put, let's just say, is $20. The 518 put is worth $8. So the difference between those two is $12, which means for my put credit spread, I collect the difference. I'm looking to make the difference between those two, which is $12. And it tells me right here at the bottom, estimated premium credit, $12. Okay. Now, go to my graph. It tells me right here. See, I wish it told you right over here. It probably does. This is a vertical. So if you're on Webull, your brokerage, whatever it is, you're probably already on single option, which it will just show you the options chain of calls and puts. Right here, you're on single option. You see how iron condor is down here too? You can open up an iron condor. You click on vertical. When you click on vertical, that's what opens up credit spreads. So you'll have the call side and you have the put side, and you go ahead, put your width in there for your strikes that you want to select for your credit spread, and it builds an entire separate options chain essentially based on the credit spreads. If you see down here, it says max loss is $287. Don't really worry about what it says the max loss is. The thing is with these credit spreads is essentially, can it cost you $287 and you're only going to make max profit is 13 bucks? Absolutely. Would you ever let it go to max profit or max loss? Absolutely not. So think about max loss is that's how much, say, collateral you have to have in your account to open up this trade. I stick to a minus 200 to 300% loss. And I'm telling you right now, even if the 521s start to go in the money, it's going to be probably around that max loss area. That's when you're like minus, 900 to 1,000%. Would you ever let a trade go minus 900 to 1,000%? Absolutely fucking not. You would have already decided to close it before that. You're like, the technical analysis got invalidated. It's nothing different. If it breaks the trend line and is breaking key areas of support, SPY, QQQ, NVIDIA, Tesla, Amazon, the market's just having a red day and you're on the wrong side of it, you cut the trade for a loss. You manage it just like anything else. You don't just hold on to it and let it just keep on draining money from your account. Or if you were in call options instead of a put credit spread and the market's dumping, why are you holding on to this thing for dear life? Cut your loss and move on to the next trade, right? It's no different. So think about the max loss. This is the collateral that you would have to have, say, in your account. So if you want to take one credit spread here for 13 bucks, it's going to cost you $287 of the cash in your account to take it. So let's just say I wanted to make $130. My max profit is $130. It's going to cost me max loss $2,870. So this is why I said if you have under $5,000 in your account, you can take one credit spread, or this case, it's 10 contracts, still one credit spread, 521, 518. It's going to use $2,870, say, of your capital in your account to make this premium, this credit of $130. So if you have only $5,000 in your margin account, you could take this one put credit spread. QQQ comes down to 524, hits trend line, goes back up to 526, makes a new high, 527 by the end of the day. Your 521 is $6 out of the money. It's worth $0.00. What does that mean on your premiums and everything? It worked out in your favor. You're going to collect the full profit of $130, move on to the next. That's kind of as simple and as easy as I can explain it. You use the same technical analysis you would on anything else. On the reason, why are you bullish on QQQ? What do you see? And you open up a put credit spread instead of buying calls, or do both. Buy calls in your cash account and then open up a put credit spread in your margin account. Make money on both accounts. Essentially, that's what I do. I just toggle over from cash to margin on my Webull account every day. I mean, that's that's about as simple as I can make it. And that's for a swing from Friday to Monday. And we'll cover something real quick on, say, we'll use Amazon or Tesla for an example, because this is something that I'm interested in. So Tesla's ripping right now. Actually, Tesla just had a massive run. I don't even want to look at those premiums right now. I mean, so did Amazon, though. Jesus. Let's do Meta. Meta has good premiums. Okay, let's go to Meta. Go to the 4-hour chart. Meta just had a 4-hour bull flag breakout. Looks really, really good, right? Get rid of these EMAs. Got the chart here on Meta, right? All the way up here. Consolidation, right? Bull flag breakout to the upside, right? So now, look at this. You got an SR flip spot right here. Where's my arrows? Boom. Look at that. You see this spot right here? See that spot right there? You see how it flipped it to support here before it ripped back to the upside? Okay, so I know that's a key area of support. What is that area? 610. Okay, 610. Let's go down to, look at that. Okay, see how this is just simple technical analysis, guys. This is nothing. Essentially, this is what I do. See that top wick right there? Is it a coincidence that there's another top wick over here that it rejected? No. That's called resistance. It just repeats itself. Mark that. What is that area? 600. So you have big support at 610 down to 600. So biggest thing is I don't want to see Meta underneath 610. So let's go to 6 DTEs on Meta. So 610 to 600. It's a $10 width. Go to 10. Scroll down the options chain. Got to change this to like 20 so it shows it. Let's see if we can find it. Whoopsies. We're going to do 10. 600, 610. Right here. Very risky because it's kind of close to the money, but they give good premiums. Sell this. My estimated premium, we're going to change it to 1. If I open up one put credit spread where I sell the 610s and for the 600s for December 13th, which is when? 6 days from now? Friday? Yeah, Friday. So next week, Friday. If my technical analysis is correct And I say, based on my technical analysis, I believe Meta is going to continue to go higher or at least stay above 610 by next Friday. I can open up a put credit spread right here where I will sell the 610s, I will buy the 600s at $10 wide, okay? And say the 610 is worth, I don't freaking know, 300 bucks. And the 600 is worth 120 bucks. The difference between those two, just hypothetically speaking, is 180 right here, which means when I open up this put credit spread where I sell the 610 and I buy the 600 by the end of expiration on Friday, as long as Meta is above 610, I make 180 bucks. Say I open up 3 of those. It will be 540 bucks. Look at my max loss. $2,460. Do you see something? We just did QQQ on the last one where it was, how many contracts did I do? 10? I think I did 10 for 130 bucks. Did 10 contracts to collect 130 bucks of profit. It would cost me $2,800, right? Meta here, 6 days out, okay? 6 days out. Instead of, it was what, 2 days for QQQ? This is 6 days out. So since it's 6 days out, what does that mean? The farther out the expiration, just like normally buying options, when you buy Meta calls, right? Versus if you buy Meta 6 DTE calls or, you know, a month out, 30 DTE calls. How much more expensive are the ones that are farther out for the expiration, right? They cost more. So since it costs more, you can make more premium if you get in now, right? So my max loss is 2,400 bucks. That QQQ one, I was going to make 130 bucks and I was going to put up $2,800 for Meta. I can get 3 contracts. And for this put credit spread, I will make $540 versus QQQ for 130. I'll make 540 bucks on Meta, and it's only going to utilize, get that out of the way, it's only going to utilize $2,400. So it's going to use less of my capital. I want to make 3 times the amount of gains, right? So this is just the beauty of credit spreads. You can work them on anything. You can find names like Meta, where the premiums are so expensive on Meta. Since the premiums are super expensive on Meta, if you want to open up a credit spread on Meta, you can make some pretty decent money because the premiums are expensive. So as long as my technical analysis is right, by next Friday, if Meta's above 610, I'll make that money. And that's just an example. So I'll show one that I did on HIMS. Where's HIMS at? HIMS is at 34 bucks. Let's fucking go. HIMS is whom. Make sure there's no questions before I do this. Zero DTE, yeah, I was like freaking crazy. Oh, so why not sell 518 by 540? So because if you do that, your spread, that freaking spread is humongous. It's going to use so much capital. The larger your spread is, the more capital. So if I go put that in to Webull right now and I go open up that credit spread, say my max profit on one contract, say that's like $1,000, right? But the max loss to collateral on that is probably going to be like fucking 30 or 50 grand. You're gonna have to put a lot of money up. So you just got to find that sweet spot with your account. How much money are you looking to make? How much cash do you have in your account in order to take these trades, right? So Bishop, if you're still here, so he said, I don't know if you talked about this, Casey, but have you traded SPX Express before? I have. He said, I personally like it more than SPY, but of course it does come with a lot more risk as you have to put up a default collateral on the spread. So Bishop, I don't know if you're still here. I think so. If I were to go to Webull right now, if I go open up an SPX put credit spread versus a SPY put credit spread, from what I've seen in the past, I haven't done it in a while. The issue that I had was the fees and commissions on what it costs to open up that credit spread was a lot more. Like I'm taking, 20 contracts on SPY to make, 100, 200 bucks. And it cost me, there's like a little net right here. And it cost me like $3 to $4 overall to open up all these contracts. For SPX, say my spread is $25 I'm going to collect for this premium, right? And I only have to open up 4 on SPX to make $100. But the fees and commissions on SPX to open up that was significantly larger than the SPY. I'm talking like when I was doing it on Webull, they were charging like fucking 20, 30, $40 sometimes to open up that credit spread versus, $3 to $4 on SPY. Webull charged me $30 to $40 on SPX. I don't know if I'm doing something wrong or if you're still here, Bishop. That's an issue that I had. The fees and commissions that I was getting. See, and look, I'll do it real quick on here. Can I do it right here? Here, let's do it real quick on Webull. I want to show you if you're on live. So look, if I go to SPY, did SPY break underneath trend line? Oh, a little bit. We'll see. Anyways, SPY. Let's do 2 DTEs, right? So let's just do a small width of. Oh, why is it not working? Here we go. Do a small width of $2. SPY is at 607. You got big support around 605, right? So let's do 605, 601, right? If I go sell this. Oh, I gotta unlock my account. I don't want to fucking do all that right now. I'll pull it up on my phone real quick. I'll do the same thing on here. So if I go to SPY, 2D is this. We're going to do 603, 601 for a $2 wide spread. 603, 601. I'm going to make $6, okay? So let's say I want to make $100, okay? It's going to cost me $1.64, okay? It's going to cost me $1.64 for this trade to open it up, and it's going to use $3,400 of buying power. So now let's go to SPX. Go to SPX. Let's go to 2 DTEs. Remember, we want to make $100. So let's go far out of the money real quick. Do a put credit spread. We're going to do 60 50s and 60. Fucking, I don't know. Let's see. Let's do see if I can do like a $10 wide spread real quick. Usually that's kind of what it is. And, all right, here's a good one. 60 30s and 60 20s. The mid is 25. Perfectly. We're going to do this. The other one with 17 contracts for like $1 and some change, right? To make $100. This put credit spread on SPX is $25. So we're going to need 4, right? $4, 4 contracts, right? To make $100. SPY was $1.64. SPX is $8.77. It's 4 times the amount of fees versus SPY. That's my issue. So when I'm doing large amounts, 20 to 30, 40 contracts sometimes on SPY, and it's charging me, $4, $5, $6 to open and close these things, yeah, I'm getting charged like $30 to fucking do that order on SPX. It's like literally it's 4 to 5 times the amount. I think it might be a Webull thing because SPX and 2S does not have insane commissions like that. I think we will charge actual commissions. That could be it. And that's my issue right now with trading SPX options. Um, on Webull, it's a lot of people love it. I believe there's tax benefits to trading SPX versus SPY as well. I believe you mentioned that the other day on Spaces actually to me. 100%. That is correct. The issue is with, and the reason why I'm in Webull right now is because I have a promo where they're paying me 7.25% APY on my account. There's like six figures in there, so I'm getting paid pretty good interest over the next 6 months right now. So I'm just taking advantage of that. Um, but I tried to do the same thing over there when I got out of Schwab and went to Webull to take advantage of this with SPX. They were charging me fucking 4, 5, 6% the amount of fees and commissions. Normally that would be on SPY, and I was like, yeah, I'm not doing SPX right now. So that was the reason why. So I might have to switch. But Robinhood apparently has SPX now. Is that the word on the street? Robinhood is starting to do SPX. So can I start doing spreads on Robinhood again with SPX now? And they don't really charge too much fees and commissions. Uh, I appreciate it, man. And Bishop said something really good in the chat. Let's see if I can find it right there. So I do SPY and QQQ. That's because I'm very familiar with trading SPY and QQQ. My technical analysis, everything on SPY and QQQ, my chart setup and strategy, it works very well on SPY and QQQ. So due to that fact, I feel comfortable taking credit spreads on those names. Yes, the premiums are lower, but again, if I'm looking to only make an extra $100 to $200 a day on that, and I can collect, $10 on my credit spread, and I'll sell 10 of them, make $100 on SPY, and I'm $5 out of the money. The probability of that happening, pretty good. SPY and QQ are not very volatile stocks, nothing crazy like a Meta or a Tesla or a Nvidia or an AMD sometimes, right? Those names can just fall off or rip out of nowhere, right? Or based on news. Um, SPY and QQQ aren't as volatile. So because of that, I feel a little bit safer to trade on those. But again, like I just showed on Meta, and like Bishop just said right here, spreads on tickers like Meta, Netflix, and HD. Because those contracts cost more when you're trading those options, if you're an option seller for credit spreads, because they're more expensive, you will make more money collecting those premiums. So depending on what kind of trader you are, what names you like to trade. And that's the purpose of me teaching this right now is, and I'm not telling you to go do credit spreads on SPY and QQQ or do zero DTE credit spreads. I'm just sharing what I do. But the overall goal is to just bring the strategy itself of credit spreads, just awareness to you guys that it's there and it's available. So if you like to trade those names, or if you're a swing trader, you can swing credit spreads. The same technical analysis on why you're bullish on Netflix right now and you're swinging calls for next month. Why can you not also swing and sell a put credit spread and make money in your other account? Make money on both ways. But people just don't, I guess, know how it works or that option's available. It's the reason why I wanted to do this. So again, I'm not telling you to go do zero DTEs and one DTEs or only do SPY and QQQ. I do that because that's what I'm familiar with. The strategy itself doesn't change. It's the same strategy. Just do it on names and charts that you're comfortable and that you trade and you're familiar with, and just learn the strategy and apply it to those names and things that you like to trade. That's the overall goal of bro. Don't betray me and TOS for Rob. I Schwab, dude. Schwab fucked me like 2 or 3 times where I had swing positions and I couldn't access my account for the first 2 3 hours of the day. Couldn't manage it, and they cost me anywhere from 500 to overall like $5,000 at one point because I couldn't manage it. Luckily, on one of them, they gave me a courtesy like credit of $500 on a day where they cost me like 1,300. They're like, yeah, here's a courtesy credit of $500. Go fuck yourself. I was like, cool, thanks. But there was 3 times where their brokerage you couldn't have access for the first 2 3 hours of the day, and I got tired of it. It's the only reason. So after earnings, it can be good strategy to earn from IV crash. Yes, sir. because that's what people do. Man, see the wheels are turning now. Now people are like, man, how can I utilize this even more? Yes, because and this is another strategy that people do. If and it all comes down to math. Um, so when say I don't even fucking know. Think of a name. Uh, what's a name? Roblox, right? Roblox, DraftKings, some kind of small cap name, whatever it is. One where the implied move is because essentially what you want is everybody to get crushed, where the thing's not gonna fucking rip, you know, 30, $50 out of nowhere. But the thing is where because those premiums are so expensive, the IV on those contracts before earnings, they're inflated sometimes, right? So the IV can be juiced on those things. So they cost a lot more. So you can go far out of the money, so you can still be safe. But those far out of the money contracts, since they're about to have earnings, the IV and the premiums, they're juiced and they cost more. So you can potentially collect more premium. So if you go $80 out of the freaking money on a Netflix put credit spread, right, for earnings, and say it's only $50, you just sell four of them, right? And you want to make $200. The next morning it goes up, cool. You're going to make money because you're super far out of the money. Say it goes down, but it doesn't go to where the implied move was for the earnings move, and it still doesn't have your puts anywhere near the money. The next morning and the next day, when the IV and the dust starts to settle, the IV gets flushed out. When the IV gets flushed out, all of the premiums in the options chain post earnings, they lose value. So if you sold a credit spread and all the premiums in the option chain post earnings are losing value, what does that mean for people that swung a credit spread on that name? You're making the money. So yes, to answer your question, can this be a good strategy for an IV crash or an IV flush from an earnings trade on a name? Absolutely. And it's, in my opinion, it could be seen as a less risky trade. People like to gamble on earnings. You know, they want to see Netflix rip 20% to the upside. So what do? They buy a call option on Netflix. The difference is if the IV on those things is juiced and say Netflix goes from 900 to 960 and you bought a 980 or $100 call, even though it works in your favor, when the IV settles the next morning and the IV comes down and those premiums start dropping, your call option is not in the money, even though it went in your favor. Your trade is red and you lose money. So instead, if you were bullish on Netflix, instead of buying that call, if you just sold a put option, if it went up, you made money. If it went up and all the IV flushed still, you made money. If it goes sideways and does nothing, you made money. If it goes down but doesn't put your strike in the money and all the IV again still flushes and puts those premiums back down to a normal price after not being juiced from earnings, your put credit spread, you made money. So do you see how that strategy seems to work more? And in my opinion, has a better it has a higher probability of making money versus normally buying regular options. Yes. So um, I think it's a great strategy, especially for earnings. I'm super glad that you actually brought that up. Um, some stocks are going straight down for a long time. Celsius, fuck yeah. Call credit spread every day of the week. Look, look at this. Go to Celsius. Go to Celsius. They're on a 921 EMA on the daily. And PLTR, put credit spread every single fucking day of the week. Go to Celsius. Let's go to a daily. They're on 921 EMA. It's the blue and orange line. Every single time throughout the week, on a Monday, Friday, I don't fucking care what day it is. Every time those things are tested, fucking open up a call credit spread. Look at that. Every single time. Comes down. Rides those EMAs. Look at that. Hits it again. Guess what I'm doing? Selling a fucking call credit spread because that's bearish. Going to go down. Look at this SR flip. Look at that double top area right here. See that right there? I'll mark that in white. Where you took the last one, it pops back up over the EMAs, hits it, it rejects it, comes back down. Fucking call credit spread. Goes back down, pops up to the 121, call credit spread. Every single fucking time. That's the thing. When you see a stock in a clear trend, downside, every opportunity to short the pop, you can buy puts if you want on Celsius. But at the same time, you can sell a call credit spread. And if it goes sideways and does nothing, you win. If it comes up but doesn't go near your strike, you win. If it continues to hold the trend and keep going lower, you win. You can just keep doing that over and over and over again. Like, oh, no. Is it? Oh, no. Restream. Make sure there's no other questions. They said it was lagging on YouTube. Yes. Call credit spread and a put credit spread is labeled as a vertical. Yep. Make sure there's nothing that I skipped over during this. Hopefully it's not lagging right now. And we're going to talk about this last one real quick before I got to jump off. Is the stream still working good? So I can cover this last part? If you're in my Discord, go to the free chat. In the free chat channel, one of my members there just posted a nice little spreadsheet that says to simplify stuff for beginners. Can I just screenshot actually for people that aren't in the Discord? If you're not in the Discord, the free portion, you should join it. Let me put this in the comment section real quick. It still looks fuzzy on my end. Let me put this in the comment. Yeah. I'm not sure if it looked like caught up a little bit. Images are blurred. Yeah. What the fuck? Let me close down some things real quick. We're just going to stick to trading view. Share a window. We'll just stick back to trading view real quick. Ah! What's up? See if this works. See if maybe that helps a little bit. The restream's starting to be blurry still. Looks like it. I'm going to put this in the comment section underneath the stream right now. One of my members that posted it in there. It's a little cheat sheet. It's a spreadsheet. Yeah, but why is it doing that in the first place? Because it's going to fuck up the recording.